Hello everyone and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are continuing with the debrief of the FM pre-December 2024 mock exam. This is the third case study based question in your section B of the exam. The name of the company is Valco Company. Let's get started. I'll first read the scenario. It's a short scenario. Valco Company, a UK-based company, anticipates a receipt of $240,000 in 1 month's time, followed by a payment of $140,000 at the same time, and expects receipts totaling $300,000 in 3 months' time. So the finance manager has collected the following information. They have given you the spot rate, the 1 month forward rate, and the 3 months forward rate, and the money market rates are also given for borrowing, conversion, and depositing. Let's have a read at the very first requirement. The first requirement wants us to calculate the expected net sterling receipts in 1 month time using the forward market. So they want to use us the forward market and they want to find out the net sterling receipts in 1 month time. So what we're going to do here is the receipt is going to be there of $240,000 and you also have to make a payment. So in net effect, it's going to be $100,000. Let's have the calculator open with us. So we have $240,000 that we need to pay, 240,000 that we need to, that we will be receiving, and we need to pay 140. So that means in net effect, we are still receiving $100,000. Now this needs to be converted in terms of pounds. Now you are supposed to take the 1 month forward rate, which is either going to be 2 or it is going to be 2.5. Now there are two questions which arise over here. Are you going to divide or are you going to multiply? And the second question being, are you going to take 2 or are you going to take 2.5? So these are the two main questions. If you answer them correctly, you will get the 2 marks in your exam. So let's first have a look as to whether we will be dividing or will we be multiplying. If you have a look at the exchange rate, it tells you that you are going to give $2 and you will get £1. That means for the same £1, you're going to pay more dollars. That means whatever figure that we want to arrive at will be a lesser value. Now, whenever you want to obtain a lesser value, do you divide or do you multiply? You always divide. That is how you will get the lesser value. So you will be dividing, that is for sure. Now, which rate will you use? Now, always remember that whenever you go for currency exchanging, there are two rates quoted, and the rate which will be taken is the one in which dealer is at advantage and you are at a loss. So what you can do is you can compare answers using both. Once you divide it by 2, so you'll get 50,000. Then you try to divide this by 2.5. So you will be getting 40,000. Now, like I told you, the dealer is going to take advantage. So he is going to charge 2.5 as the rate to you and he will give you 40,000 pounds. You are at the receiving end. So you would prefer to get 50,000, but the dealer will prefer to give you 40,000. And the exchange rate market works like this, that the dealer will always get advantage. So he will give you the lower receipt. He will only give you 40,000 pounds. Moving to the next question, 27. Calculate the expected sterling receipts in 3 months' time using the forward market. So you are receiving a total of 300,000 in 3 months' time. So again, I'll open the calculator. So this is 300,000 which you're going to be receiving. Again, what we are going to do is we have to divide and we will be using the higher rate because with the higher rate you get lesser receipts. So in net effect, you're going to get 100,000 pounds. This is your answer. Very simple, this question. Third requirement in this scenario, what will be the equivalent pound value of the expected receipts in 3 months' time using a money market hedge? Now, here you're talking about receipts. Always remember there's an acronym which is going to help you remember how you work out a money market hedge. So if it's the case of a receipt, you're going to follow BCD, borrow, convert, and deposit. And if it is the case of a payment, it's going to be the opposite. It's going to be DCB, deposit, convert, and then borrow. So this is what we follow. Since this is the scenario of receipt, we are going to follow the BCD approach. We will first borrow the foreign currency. We are based in the UK, so the foreign currency for us is the dollars. So we are going to borrow dollars. These are the rates for 1 year. Please be very careful. We are doing the calculation for 3 months. So every rate will have to be adjusted accordingly. So the first thing that we will do is that we borrow money. How much do we need to borrow? Let's find that out. Firstly, let's find out how much will be the rate. We are going to borrow in dollars. 12% is the rate of interest. 12% is what they charge. Now, this is for the entire year. You want it for 3 months. So, this will be divided by 12 and then multiplied by 3. This means 3% will be the rate for 3 months. So the first step is that you're going to borrow in terms of dollars. So how many dollars do you need to borrow? You're going to receive 300,000 pound, $300,000. So let's see how much do you need to borrow today. So 300,000, and this will be multiplied by 1 divided by 1 plus the rate of borrowing. So rate of borrowing we just calculated as 3%, so 1.03. So this gives you the amount of money, the amount of dollars which you need to borrow today. Now you have borrowed this money today. You will convert also this money today. So we will use the spot rate for conversion. Now this amount is in dollars. I want pounds. So higher rate will be applicable. I will divide these dollars by 2. This gives me the money that I have today in pounds. This is in pounds. 145,631 is pounds. Now the third step is that I need to deposit it. I need to deposit. This is pounds that I'm depositing. Sterling interest rate. Deposit rate is 10% for the entire year. So for 3 months, it will be 10% multiplied by 3 divided by 12. That will give you 2.5. So how much money will you have? You will have the principal. You will have the answer. It was 145,631.07. This is what you are depositing. You will be getting this plus 2.5 interest on it. So we can say 1.025. So the money that you will be getting at the end, this will be the equivalent pound value. This will be option 2, which is 149,272. Moving ahead to question number 29 now. What is the impact of a fall in country's currency value? So always remember that if your currency's value is falling, that means the currency becomes cheaper for the ones who are living in a foreign land. So for example, if over here we talk about dollars and rupees, if the value of dollar is constantly appreciating, means the rupee is depreciating, what happens is that the rupee becomes very cheap for the person who's sitting in America. So if he wants to buy something from India, it's going to be very cheap for him. So this is definitely true that if India's currency falls, exports will definitely be given a stimulus. Even China has been accused of, following a system like this, wherein they deliberately undervalue, depreciate their currency so that the exports are very cheap for other countries, and they trade more and more with China. Second statement tells you the rate of domestic inflation will rise. Now, this is definitely true. If you see the currency falling, that means there's a lot of supply of that currency that is available, but not much demand of the currency is there. So, if anything is high in supply, that means money is, readily available, I would say, to everyone. Everyone is ready to spend in the economy. So if everyone spends and the number of goods remain limited, definitely inflation is going to rise. So both 1 and 2 are correct. Moving towards the very last question that is associated with this question, with this case study, which of the following characteristics is typically associated with forward contracts? Now, always remember forward, the second letter O. Remember it with this, that O stands for OTC. That means they are over the counter agreements, they are not exchange traded. So these are OTC contracts. So the first statement you can simply eliminate. First statement says that these are exchange traded instruments. These are not. So the first statement can be eliminated. Second statement says they involve standardized terms and conditions. This is okay. Let's go further. Third statement says legal binding contracts which predetermine the rate for a future transaction. This is exactly what we do over here. We are setting in advance that this is the rate at which we will be, doing the transaction. Uh, Moving to the last statement, they are rights but not the obligations to buy or sell on a future date. These are options and not forwards. Options give you right but not the obligation. Here, the statement is asking you about forward contracts. Going back to the second option, they involve standardized terms and conditions. When will it be standardized? Is when there is an exchange involved in the process. Since there is no exchange, these are over the counter, they are not standardized and rather they are tailor made, they are custom made according to your requirements because it is only for you that they are arranging this contract. So the second statement also gets eliminated. With this, the third one is the answer, and I've already told you the reason why this is the answer. With this, we come to an end to the discussion of your section B of the FM pre-December 2024 mock exam. Do let me know if you want me to create the videos for section A as well as section C. Thank you for watching. I hope that this was useful for you. All the very best for your exam.